Good morning, everybody. I hope you're having a nice morning. It's kind of cloudy here in Calgary. This is series webinar that will present our latest Canadian oil and gas production forecast and outlook. If this is not the webinar that you're planning to attend, I think you might be in the wrong event. But please feel free to stick around. I'm just going to give a couple more minutes for other attendees to arrive, and we will begin promptly. Thank you so much. Welcome, everyone. This is Canadian Energy Research Institute's webinar that will cover our latest production forecast that we've published for the Canadian oil and gas industry. My name is Dinara Millington, and I'm Vice President of Research at the Canadian Energy Research Institute. I'm also your host and presenter for this morning's presentation. Just before we begin, I'd like to go over a couple of housekeeping remarks. So in terms of your audio, your microphone is muted for the duration of this presentation, so you'll only be able to hear me, but not be able to speak. And there is information there to connect to the audio via your microphone that's built into your computer or through the telephone number that's provided there with an access code. For questions, you can submit your written questions in the questions panel that you see there as part of your dashboard for the Go webinar. Because I am the host and the presenter, I will not be able to tackle questions and do the presentation at the same time. So I encourage you to write the questions, and we will get to them at the end of my presentation during the Q&A. Also, a copy of this PowerPoint presentation is available to you in the handouts panel. Again, that's just underneath the questions panel there. So you can either follow along the presentation that I'm providing here, or you can download your version as well. All right, so let's start. But first of all, I would like to take this opportunity to acknowledge that we are located on the traditional territories of the people of the Treaty 7 region in southern Alberta, which includes the Blackfoot Confederacy, as well as the Tsuut'ina First Nation and the Stoney Nakoda. The city of Calgary is also home to Métis Nation of Alberta Region 3. Before we get to the main point of this presentation, just a couple of words about CERI, if you're not familiar with us. The organization was established 45 years ago, and we're an independent registered charitable organization specializing in analysis of the energy, economics, and related environmental policy issues. All of our research is publicly available on our website, so please I encourage you to check out the reports that are associated with presentation, but other topics that are of interest to you. We also publish geopolitics of energy on a monthly basis and quarterly commodity updates. Our petrochemical conference this year, unfortunately, was canceled due to the ongoing pandemic, but the new dates are now available for, and we're planning to host it in June of 2021. We wouldn't be able to complete all the research that we do here with my research team if it wasn't for gracious support of our core funders that you see here on your screen, as well as the support from other organizations. We also receive in-kind support from various organizations within the country and the province. This morning presentation is the outline is as follows. We will go over briefly, just to contextualize the Canadian oil and gas industry. We will start with a broader perspective, looking at the global oil and gas markets. Then I'll present a snapshot of where the Canadian oil and gas industry is today. As well as, and then sort of switch over to talking about our assumptions that we have played with and worked with to deliver our Canadian oil and gas production scenarios, as well as associated greenhouse gas emissions. This year, the production forecast reports are in abbreviated format, which means that we did not analyze the the greenfield projects for oil and gas industry, just given how uncertain the current climate is, and understanding what the capital investment is was almost practically impossible for us to do, and so we avoided doing the greenfield project supply cost estimation. And then I will wrap the presentation with conclusions. While you're following along, this presentation is being recorded and also be available at a later point on CERI's YouTube channel. So please check that out. All right, so we'll get straight into it. Well, if you're just arriving to the planet Earth, we've been under a COVID-19 pandemic, and it's still ongoing, and there's still an environment of high degree of uncertainty in terms of trying to identify how our energy and even global energy sectors would deal with this pandemic and what the overall impact would be. But so far, what we're seeing is that the impact of containment measures in 187 countries around the world has almost brought global mobility to a halt. And this is not just the passenger mobility, but we're talking about supply chain disruptions and overall trade. The International Energy Agency identified that demand for oil in form of refined petroleum products was down by almost 30 million barrels per day. And this was a comparison of April 2020 to April 2019, falling to a level that last was seen in the year of 1995. On the annualized basis, the global oil demand is predicted to be almost 9.5 million barrels per day lower in 2020 versus 2019 statistics. A strong rebound in the economy in the second half, which we're not seeing yet, it would reduce the annual decline in oil to only 6.5. However, given how uncertain times are, and if there were a second wave of COVID, the decline in oil demand could even be greater. And we're seeing the second wave of COVID-19 presenting itself in some parts of Europe, and even, I believe, within some regions in Canada, that we're witnessing a significant increase of cases and hence announcement of a second wave. All right, so this is the sort of, looking a little bit more long-term. What you're seeing here is the latest BP Energy Outlook scenarios. Again, I just want to reiterate, these are scenarios. These are not predictions of the future. And while this scenario, especially on the consumption side, is quite pessimistic, I would say, for a couple of scenarios. It is something that I wanted to show to the audience and to just try to sort of understand where, how wide the uncertainty is and how wide the range of where we're going for global supply and demand and this particular one is for liquid fuels, so crude oil and condensate. So they demand under two scenarios, which are rapid and net zero, and these two particular scenarios go hand in hand with the UN sustainability goal of not increasing the global temperatures by more than 2 degrees Celsius. Under these two particular scenarios, the oil demand never recovers from the fall caused by COVID-19, which implies that the oil demand has already peaked in 2019. The demand declines to less than 55 million barrels per day under the rapid scenario and around 30 million barrels per day under net zero. In contrast, after recovering from COVID-related impact, oil consumption is flat at around 100 million barrels per day level for next 20 years, and then slowly decreasing to 95 million barrels per day by 2050 under business as usual scenario. The outlook for liquids demand is dominated by the impact of the pandemic in the short term, as we're all aware, and the declining use in transport sector. Further out, the non-combustion use of liquid fuels, largely as a feedstock in the petrochemical sector, would provide some degree of support to the overall demand. Despite the weakness in oil demand, under the rapid scenario, U.S. tight oil production recovers from the impact and grows until early 2030s. And this increase in the output is offset by the fall in the OPEC production and OPEC plus production. However, thereafter, OPEC production does stabilize as declines in global demand are broadly matched by the fall in US production and other non-OPEC supplies. By 2050, non-OPEC production accounts for around 2/3 of the total decline in liquid supply under the rapid scenario. Under business as usual scenario, US production continues to grow for the next 10 years, and it's offset by the decline in OPEC production. Declines in the US tight oil and other non-OPEC output from the mid-2030s or thereabouts provides a scope for OPEC to increase its production despite the backdrop of gradually falling demand. By 2050, the level of OPEC production is broadly unchanged from its 2018 levels. So switching over to global natural gas markets, what we have seen, and this is statistics from the International Energy Agency for the first quarter from January to April 2020, and it compares the level of the demand by various sectors in the same period of 2019. What we have seen is natural gas consumption was falling in the first quarter of 2020 in major markets, even prior to pandemic starting, mainly due to milder temperatures in Northern Hemisphere. In Europe, milder weather pushed down natural gas demand by estimated about 3% during the first quarter. And similarly, in the US, natural gas demand decreased by an estimated 4.5%. Mature Asian markets also experienced a contraction in natural gas consumption. We saw LNG imports in Japan falling by 3% in the first quarter. And Korean domestic sales for January and February fell also by 2.5%. Natural gas demand in China was essentially flat, while in India it grew almost 8% in the first 2 months of 2020. Natural gas supply, however, did not adjust to this drop in consumption, which has resulted in a considerable buildup of gas in natural gas storage, and we see that in the Canadian data as well. US dry gas production grew by 7% in first quarter, while global LNG trade increased by an estimated 13%. In the United States, inventories rose by 77% compared to 2019 levels, and they are currently 17% above the 5-year average. Switching over to the long-term scenario and outlook scenarios from BP, what we're seeing is the outlook for natural gas is definitely more durable than for oil, which is helped by broad-based demand and increasing availability of global supplies. In rapid scenario, global demand for natural gas, which includes traditional natural gas and biomethane, recovers from the near-term dip associated with the pandemic and grows relatively robust over the next 15 years, driven mostly by economies in developing countries in Asia, China, and India, as well as they switch from coal power generation to natural gas. In the latter part, demand declines as demand fades in Asia and compounded by a decreasing demand in the developed world, such that the global demand in 2050 is close to 2018 level. Under the net zero scenario, the growth of gas consumption is short-lived and its peaks in mid-2020s, and by 2050, gas demand is 35% below 2018 levels. In contrast, gas demand increases throughout the next 30 years under a business as usual scenario, and it is understood to be supported by strong demand growth in Asia. The main areas of increasing supply under the rapid scenario come from China and Africa, supported by rising domestic consumption. US and Middle Eastern gas supply by 2050 is largely unchanged from 2018 level, with falling domestic demand being offset by increasing exports in the form of LNG. So looking a little bit closer at home, so what has been happening to the Canadian oil and gas industry? So let's start with the Canadian crude oil and liquids production. What we saw in 2019 is an overall annual production increase by close to 2% as compared to 2018 levels. The growth and overall production is definitely driven by oil sands, non-upgraded and upgraded bitumen. While we saw a 2% increase in the annual production, we also saw a almost equivalent 2.5% increase in exports of Canadian crude oil to United States. And that is the bottom chart on the slide here. The US Midwest region, or PADD2, is still a dominant market for Canadian crude, capturing almost 70% of all Canadian imports. However, the US Gulf Coast, which is a PADD3 region, is a growing market, which evidenced by growing Canadian imports into that region. So what has been happening there is that over the last few years, the crude oil exports that are coming from countries, Latin American, South American countries like Mexico, Colombia, and Venezuela, have been on the decline, where Canadian crude was able to capture that market share. Currently, the volume of Canadian exports to the Gulf Coast amounts to about 500,000 barrels per day. Majority of that is made up of the heavy crude supply. We see a slightly opposite picture to natural gas. Here, what we're seeing over the last, in 2019, we saw an almost 3% decrease in the annual production of Canadian marketable natural gas, and that level sits at around 15.7 billion cubic feet per day. While we saw a decrease in the overall production, we also saw a decrease, 11% decrease in net gas exports, which fell from about 5.5 BCF per day to just under 4.9 BCF per day. When you look a little bit out further to the first quarter of 2020, which is not shown here on the chart here, but we see a further decrease in gas exports. Well, similarly to other countries, the federal and provincial governments in Canada have urged people to practice physical distancing when the pandemic and the quarantine was announced sometime in mid-March of this year. The governments imposed stay-at-home measures and restrictions on non-essential travel to flatten the curve and avoid the risk of overloading provincial healthcare systems. Household spending dropped as people remained in isolation and governments began to order the closure of non-essential goods and services establishments. The overall demand for goods and services in the economy decreased, and as businesses experienced weaker earnings, cost-cutting measures were put in place and unemployment increased. And I don't want to take away the thunder from our upcoming Recovery Pathways study for the energy sector, but I just wanted to quickly present some of the statistics here. The International Monetary Fund projects that the real GDP in Canada could decline by almost 4.5% this year, which is similar to other large economies that you see here on your chart. There is, however, consensus among international economic organizations that China may be the only large economy that could see a positive, mind you, small, what we normally would see traditionally China's real GDP growth would be. And it amounts to about 1% growth. Specifically, just some statistics for Canadian experience. We saw a significant decline in our labor markets, and not just in the oil and gas sector. During the first quarter of 2020, the value of total Canadian exports dropped 3% quarter on quarter, and import values also saw a contraction during the first quarter. The weaker earnings in the goods and services industries triggered a natural response of cutting back on future capital spending. The grimmer economic outlook took a toll on investor confidence, and the global equity markets tumbled with fears of potential recession. Manufacturing operations came to a halt in Canada and United States, caused by supply disruptions of inputs and stay-at-home orders. As a result, merchandise trade in Canada experienced a steep decline in April, with merchandise exports and imports falling by 30% and 25% respectively. Zeroing in on our Canadian oil and gas sector, so what you're seeing here is the chart and a table for employment in the oil and gas producing provinces. COVID-19 had a significant impact on the energy-related activities in Canada. There was a sharp decline in the energy demand, as I already shown you, and energy-related trade, which together with the initial Saudi-Russia confrontation, which triggered a drop in energy prices and demand. These factors continue to present challenges for the energy sector in Canada. Even prior to COVID-19 pandemic, market access, regulatory uncertainty, and the actions of OPEC Plus were already having a negative impact on employment rates and performance within the oil and gas sector. Since the pandemic and the countrywide lockdown introduced in March, unemployment rates have increased in all of the oil and gas producing provinces. And today it's still uncertain how long it will be before the sector returns to, pre-pandemic, some sort of normal employment levels. All right, switching gears a little bit here. What I'll do is present some of the assumptions that went into our setup of our scenarios for production of Canadian oil and gas. Based on the global and domestic supply and demand assumptions and CERI's July 2019 production forecast, CERI analyzed 3 potential scenarios to investigate how Canadian oil and gas production is impacted. The global demand assumptions for 3 scenarios are shown in the green table, and the scenario assumptions that are specific to Canadian oil and gas production are in the table below that. Given the overall production impact assumptions, the next step is to estimate the provincial shares of the production losses in provinces where crude oil is produced. For this purpose, we assumed that the major oil producing provinces, such as British Columbia, Alberta, Saskatchewan, Manitoba, are affected by the production cuts. We have exempted Newfoundland and Labrador offshore production because of its specific geographical location and market structure and its ability to access global Brent prices. On the natural gas side, we assume that the natural gas exports to the US and domestic natural gas consumption will not alter significantly in different industrial sectors, except for Alberta oil sands industry. Given that the production decline in the oil sands industry, we have analyzed a parallel consumption decline in natural gas that would be required for oil sands projects. And hence we estimate the natural gas production loss by calculating the consumption intensities for in situ and mined oil sands extraction processes based on historical data. And then we use these intensities in bitumen production cuts to estimate the natural gas consumption reduction. When it comes to the assumptions of the LNG projects, we kept the assumptions the same as we did in our forecast last July. So what you see here are three scenarios for which the assumptions that were just outlined in the previous slide. So based on scenario one, the total production cut, and this is the conventional crude oil production, which includes provinces of Alberta, BC, Saskatchewan, Manitoba, Newfoundland, and the condensate production from Alberta and BC. So on the conventional side, without looking into oil sands, the total production cut in 2020 for conventional side will be around 85,000 barrels per day. After 2021, we expect that the changes will be negligible and the production will continue to grow. In a scenario two, the production cut is larger and it averages around 285,000 barrels per day in 2020, about 200,000 barrels per day in 2021. And we are seeing a permanent loss of conventional production of around 57,000 barrels per day from 2022 to the end of the forecast period. Scenario three, which is the least optimistic production scenario, we're seeing a significant production cuts in order of almost 500,000 barrels, and a permanent production cut of about 170,000 barrels per day would be expected. The production cuts are distributed among Western Canadian provinces according to their share of the total Canadian oil production. So this is in the short term. In the long term, after 2022, we're seeing for all scenarios, the production levels are estimated to increase up until mid-2020s, which is followed by a slight decline due to estimated fall in production in offshore Newfoundland and Labrador. By 2039, Alberta, followed by Saskatchewan, will be the main leaders in the growth of the conventional crude oil production. But we can't talk about Canadian crude oil industry if we don't mention the oil sands, which currently represents about 2/3 of the overall total Canadian crude oil and liquids production. Again, here in the table, you see the production losses that are associated specifically with the bitumen production. On my left-hand side there, you see the graphs for three different scenarios. And then the last chart just brings the total level of production together under one chart. So a significant milestone was reached for Canadian oil sands production of 3.1 million barrels per day in 2018, and it was maintained in 2019 as well. In 2019, oil sands production was made up of about 1.6 million barrels per day coming from in situ projects and about 1.5 million barrels per day from mining projects. When we look out further and look at taking into consideration the production losses that you see there in the various scenarios, we see that under scenario one, the production is set to decline by about 215,000 barrels per day, which will fully recover in 2021. And the least optimistic under scenario three, we're seeing significant losses there amounting of over 1 million barrels per day, with a permanent loss of about 430,000 barrels per day by 2030. So bringing the conventional and oil sands production together, what you see here is in the short term, we are going to see a significant, well, the range is definitely wide enough to cause some worry in terms of where the oil sands and the conventional oil projects will end up in terms of its overall production losses. But in the long term, medium to long term, the production is expected to recover in all three cases. However, they are under various levels of overall increase, because under scenario 2 and scenario 3, we are estimating some volume that will be permanently lost within the industry. Switching gears to Canadian gas production scenarios. Again, what you see here are three scenarios for gas producing regions of Western Canada, specifically Alberta, BC, and the little volumes that are coming from Saskatchewan. We're still assuming two major large-scale LNG projects on the West Coast, and one small-scale project on the West Coast, and one large-scale project on the East Coast. We're assuming that the gas for the East Coast project will be sourced 100% from Alberta. However, the other project on the West Coast, the gas will predominantly be coming from the British Columbia shale gas resources, with an assumption that for one of the projects, 10% of that LNG capacity will be met by the production of gas coming from Alberta. Again, as I mentioned, for natural gas, we assume that only Alberta natural gas production would be affected. And the gas consumption cut due to production decline in oil sands, we assume, is equivalent to the gas production cut in Alberta. In all three scenarios, we expect an increase in gas production due to gas that is needed to feed the LNG projects. After 2029, gas production will stabilize through the remainder of the study period. And note that, as I mentioned, the gas for LNG is expected to be supplied by British Columbia and Alberta. On the flip side of that, if you were to assume that none of the, or maybe only one LNG project would be going ahead, we would see a tremendous impact on overall gas production, where instead of the growth, we probably would see somewhat of a flattening impact on the industry. All right, so the next couple of slides deal with the associated greenhouse gas emissions. The emissions are estimated to move in tandem with production levels. The greenhouse gas emissions will decline in proportion to the decrease in the oil and gas amounts. The annual emission levels from conventional oil production, excluding oil sands, were around 30 million tons per annum, as we estimated in our last year forecast. Considering oil production levels for three scenarios, the annual emissions from oil production in scenario 1 will remain approximately the same. And in contrast, because of the higher production cuts under scenario 2 and 3, lower average annual emissions are expected. Again, here we note that Alberta and Saskatchewan are expected to generate the highest emissions during the study period. On the oil sands side, this figure presents the oil sands emission projections based on the three production scenarios that I showed earlier. Here we include emissions that come from existing upgrading, electricity, and fugitive emissions and flaring. Current on-site emissions are projected to change in tandem with bitumen and synthetic crude oil production. Future emissions are calculated here based on historic emission intensities, which have been decreasing, but do not reflect any future innovation or technology change to reduce emission levels. However, Considering historical and present efforts by many operators within the sector to reduce emission intensities, improvements in emissions over the forecast period are within the reach. Hence, consider this outlook as a conservative outlook. Later down this year, we will evaluate emissions from oil sands technology innovations in our upcoming study. And report will outline the impacts of improving emission intensity due to technological improvements in the oil sands industry. Given the short-term production decline forecast in all three scenarios, emissions do decline in parallel in the short term. In a medium to long term, emissions start to increase, reaching almost 100 million tons per year in 2030 under scenario 1. And 95 million tons in scenario 3 and 87 in scenario 3. Sorry, that was a scenario 2 for 95 million tons. As you can see, the provincial mandated cap on the oil sands emissions levels of 100 million tons per year is not reached until well into 2030 period. However, as I mentioned, this is a conservative outlook. And with implementation and adaptation of various innovative technologies that drive the overall emission intensities further down, we would expect that 100 megatons will be pushed down further into the forecast period, or potentially might not even be reached at all. These are greenhouse gas emission slides associated with natural gas production scenarios. Stemming from the gas production scenarios, the average annual emissions are estimated to be about 44.5 million tons per annum for the forecast period. Considering the gas production levels for three scenarios, the annual emissions from gas production in scenario 1 remain approximately the same as outlined in our last year forecast. In contrast, because of the higher production cuts under scenario 2 and 3, we would expect lower average annual emissions. In this particular case, on the gas side, Alberta and British Columbia are expected to generate the highest emission levels during the study period. The yellow line here indicates the total greenhouse gas emissions that are associated with gas production without applying the methane emissions regulation and policy. This particular emissions forecast includes emissions from all upstream natural gas that is estimated to be produced for domestic use, pipeline transportation, and LNG exports. And sort of just to wrap it up, I have a couple of concluding slides, but I would encourage the audience to start typing up your questions if you have any. But in conclusion, what we're seeing for the industry, that companies are looking for the next new normal in the oil and gas markets during this uncertain period. Lower prices and uncertain demand growth mean that many companies may need to permanently lower their cost structure even further. Various oil and gas companies need to be able to be more agile, to be able to ramp up and down their capabilities and the capacity to match various external conditions, whether that's global market fundamentals or geopolitics. Companies should also ensure that the capital investment cuts in 2020 do not reduce their ability to scale production in the near to midterm. On the gas side, adapting to sort of lower for longer in the global natural gas markets. However, even though the prices are currently low, shale gas might see their revenues rise, providing an opportunity to consolidate through targeted M&A activity. For the LNG exporters should play the long-term game. While margins may be tight in the next couple of years, international natural gas prices are highly volatile and as recent as 2018, we saw LNG trading in double digits. Cancellation of new LNG projects may ease the oversupply in the short term, but maintaining investment could be critical to ensuring security of supply and preventing a natural gas crunch later in the forecast period. Future demand for natural gas will depend on distribution infrastructure with countries like India, for example. Larger oil and gas companies with diverse LNG portfolios should consider investing through the cycle to build long-tail demand growth in a diverse number of economies in Asia and Latin America, because that's where the demand is. And companies would need to balance short and long-term priorities in the face of low energy prices and the overall energy transition. Many companies have been able to lower their operating costs already and increase their revenues by replacing, doing activities like replacing older equipment, identifying sources of fugitive methane emissions, and boosting overall energy efficiency of their projects. In times such as these of tighter margins, the benefits of these programs should increase. For large oil and gas producers and suppliers, the consumer and investor push for lower carbon energy sources will likely to continue. The importance of ESG metrics, the environmental, social, and governance, and corporate purposes would only become more prevalent and will become a regular factor of any business model. So companies should consider expanding their, whether they expand their asset base or research efforts into studying biofuels, carbon sequestration and utilization, and even power trading and services, so they're better positioned for the economic recovery. So with that, I thank you very much. This completes my portion of presentation, and I just want to, maybe before I get into the Q&A, just do a couple of slides here on upcoming events. Our next webinar would be about a month from now. That will cover our recent study that we're doing in 4 different parts, looking at the economic recovery pathways for Canadian energy industry, where we split the Canadian energy industry into the traditional hydrocarbon, oil and gas, electricity, and renewable energy. So hopefully we'll see many of you there. And again, our upcoming petrochemical conference will be held again in Kananaskis from June 6th through 8th. And please visit our website to register for these events. And with that, I thank you very much, and let's get into the questions here. So let me just give me 1 second here. All right. All right, so the question came regarding the global demand scenarios and the associated sort of bitumen production scenarios. So let's see. An earlier slide shows 3 global demand scenarios, the usual rapid and net zero, that show declines in demand, but the bitumen production scenarios show a drop in supply, but then significantly increases. How do you reconcile this? Great question, Dennis. Thank you so much. So we, again, the BP Energy Outlook presents various scenarios that were, again, these are not forecasts, and they do present a wide range of potential future that we might see for the energy sector. When it came to the bitumen production scenarios, again, we have a better understanding of the various projects and the overall production decline was sourced not necessarily from the BP Energy Outlook, and it came from a secondary source. And so I wouldn't necessarily tie BP outlook, BP scenarios on the demand side with the bitumen production. However, maybe what I can do is I can turn this question around in terms of why we're seeing this increase in the long term, medium to long term in bitumen production. What we have assumed in our long-term, medium to long-term outlook is that the Western Canadian region adds an additional pipeline capacity for market access, and we're assuming volumes in the form of Canadian crude oil exports reaching the market, such as Gulf of Mexico, and continue to feed PADD 2 refineries. Also, we will also be looking at, and this is something that we wanted to do a little bit more detail, is to understand the opportunities for bitumen beyond combustion. So things like carbon fiber, extraction of metals like vanadium, lithium, that potentially could further expand the industry without necessarily refining bitumen into the refined petroleum products. We are also would be expecting some demand destruction on the transportation side. However, the uplift that would be offset would come from, for example, petrochemical sector or continuous increase in demand in Asian markets. With a successful implementation of Trans Mountain system, hopefully the producers will be able to reach those markets in Asia where the product quality would be matched with the refining capability in those markets. All right, was there any other questions? Oh, right, so hold on one second. Next question, what would the drastic decline in worldwide demand due to prices? And will those prices be too low to justify expansion in Canadian oil patch? The short answer is yes. I mean, the price is sensitive to the dynamics between the supply and demand of crude oil and its markets. Whether the prices would be too low to justify greenfield expansion in Canadian oil patch, that would depend. And what I mean by that is it will depend on each individual producer being able to increase production while operating in the low crude oil price environment. Yes, greenfield expansion of bitumen projects are traditionally have been higher on the cost per barrel basis among other producing basins around the world. But you know, there are projects that could continue to expand their production by adding additional phases and not necessarily going fully greenfield expansion. All right, sorry, 1 second. I think this is it for questions, unless somebody else is typing in a question. Let's give you a minute or so. So I guess maybe before, you know, while we're waiting for another question to pop in, I will address the sort of technology and innovation part of it. I think there's a lot to be looking forward to on the innovation side and improvements due to technology adaptation as it relates to overall emissions reduction and cost reduction. So stay tuned for our upcoming study, and I'll be very excited to present that. does your projections assume that all proposed pipelines will be built? So in our forecast, we assume that the following projects will be going ahead: the expansion of Trans Mountain system, the build and operating of Keystone XL, again, which is again highly uncertain now. The line 5 and 3 refurbishments to address some of the Eastern Canadian imports and potentially be able to expand Western Canadian supply to those markets, as well as we assume the ongoing projects that are happening within Enbridge and Plains Midstream. They're looking at expanding the existing system, and I believe reversing the Alberta Clipper line to carry bitumen as opposed to condensate from the Gulf. Okay, next question. Regarding bitumen production, can you speak generally to what the model would project if new pipelines are not completed? Excellent question. So, you know, the current existing export pipeline capacity, and I guess maybe I could have shown that slide on the throughput and the overall capacity, is able to carry the existing production, the existing available supply that is available for export. Without additional pipeline capacity, I guess what I'm going to split this a little bit here. So if the new pipelines are not completed, we will potentially see a significant downturn in the oil sands sector for greenfield development. However, the reconfiguring of the existing system would add almost 1.2 million barrels per day. So that's, you know, additional volumes that would be available, additional capacity that would be available to move the supply. But you know, you are correct to sort of to mention that without additional market supply, how much can we grow the bitumen production? I don't have the exact answer, but I think that overall it will have a tremendous, significant negative impact on the bitumen production levels, unless we can figure out a way to produce bitumen and not ship it on a pipeline, whether that's increased rail or looking to products that are beyond combustion. And, you know, if we were able to supply the world with, you know, asphalt and carbon fiber and metals that are required for battery production. But, you know, those beyond combustion technologies are still, they're still further away from being able to be adopted at the commercial scale. So the research and development and innovation, you know, is playing a key role when it comes to this segment. All right, I think this is it for questions. If you have any other questions, please feel free to reach out. You can reach out to our general email at info@ceri.ca or to me directly at dmillington@ceri.ca, and hopefully I'll be able to answer your question. But otherwise, thank you so much for attending, and I look forward to, well, seeing you virtually for the next webinar. Thank you so much and take care.